Thanks for clicking. Canadian real estate experts are clashing over how best to provide mortgage relief. This according to a new report from Canadian Mortgage Trends.
I'm gonna say the day.
And the report comes amid a growing number of calls to make holding on to a mortgage easier, with Finance Minister Chrystia Freeland recently touting the new FCAC mortgage relief guidelines, and leader of the NDP, Jagmeet Singh, recently calling for mortgage subsidies.
Like Spain has taken to force banks to give lower interest rates to families that are struggling. Like Portugal has put in a subsidy for people that can't pay their mortgage right now.
And while the report offers some short-term, often conflicting solutions to Canada's real estate problems, it does call for the need for a longer-term solution and points to a recent CMHC report arguing that Canada needs to build 3.5 million more homes by 2030 in order for the housing market to become affordable. However, going over the report, it's not clear that any of these measures will make the real estate market any more affordable, and it's equally unclear that the powers that be actually want the increase in supply. So what I want to do today is go over the relief measures being suggested by the real estate industry, take a look at CMHC's report, and then go over the potential for an increase in supply to actually make Canada's real estate market more affordable. Speaking of affordability, it is the end of the month, and we're expecting to get Canada's real estate data out from the local boards late next week, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this report. As mentioned, Canadian Mortgage Trends spoke to a number of real estate experts about how to best provide mortgage relief to both homeowners and home buyers. Jasmine Tour, Director of Public Affairs at Mortgage Professionals Canada, said that we are at risk of an entire generation giving up on the dream of homeownership. As such, says Tour, we should consider extending amortizations on insured mortgages, those with less than 20% down, from 25 to 30 years. While also increasing the cap on insured mortgages from $1 million up to $1.25. And this isn't to be confused with the longer amortizations being offered by the banks to holders of variable rate mortgages with fixed payments. What Tour is suggesting is that we extend the amortizations being offered to home buyers that have less than 20% down, those getting government-backed insured mortgages. However, Romy Bauer, CEO of CMHC, recently addressed this, saying that making it easier to borrow more is not the answer to affordability, noting that that would just increase access to credit. And I think that's definitely true. If amortizations were increased from 25 to 30 years, that would just increase the amount of credit available to homebuyers, government guaranteed credit at that.
Well, that's not going to happen.
Canadian Mortgage Trends also spoke to Dustin Woodhouse, CEO of Mortgage Architects, who looked at the other side of the coin, making mortgages more affordable for those who already have them. Woodhouse argued that we should be looking at allowing 50-year amortizations, but only for those who are already homeowners. Woodhouse readily admitted that extending amortizations to 50 years wouldn't necessarily be the best thing, but if it's between a 50-year amortization and homeowners having to sell their houses and then rent for the rest of their life, then how is renting a better solution?
That is a really good point.
And that's true enough, and we've talked about that before on this channel. The powers that be are going to have a real difficult time saying that it's safe for existing homeowners to have 50-year amortizations, but not so safe for potential homeowners. But I think these two views, on the one hand coming from MPC, increased amortization for homebuyers, and the other coming from Dustin Woodhouse, increased amortizations for homeowners, get to the crux of the conflict, almost the politics of it. These experts in the industry are talking past each other as they're trying to fix two very different, even conflicting problems. Making mortgages more affordable for existing homeowners will make them less affordable for home buyers. It's imposing two very different sets of rules on two sets of the population determined by property ownership.
I come to claim the right.
And that's where the supply argument comes in. Enter CMHC, which says that it would prefer to see the industry focus on increasing the supply of new homes in order to make housing more affordable. Increasing the amount of supply available on the market wouldn't change the rules of the game mid-game and wouldn't involve an expansion of credit. Now, myself and others have definitely been critical of the supply argument in the past, but critical to the extent that I think that the housing bubble was caused by free money rather than a lack of supply.
I see no evidence of that.
And I think statistics appear to bear that out. But I do think that basic supply and demand is at work, and if we have an increase in supply, we will see prices come down. And CMHC just recently released a report saying that Canada needs an additional 3.5 million new homes built by 2030 in order to get housing to become affordable. And by affordable, CMHC wants to see the average price of a home drop dramatically over the next few years. In Ontario in 2021, the average price was $871K, and they want to see that come down potentially to $499K by 2030, or maybe $551 depending on how it plays out. So the average price of a home down to $550K in Ontario by 2030.
I find myself in need of a second job.
That definitely sounds like a laudable goal, but I'm not so sure that the banks or the government are going to be that happy with the value of the bank's assets dropping so dramatically. Just as a brief example, let's take that homeowner that bought that $871K house in 2021. Let's say they put 20% down, they locked in at a 5-year fixed term at 2%. They would now owe $583,000 by the end of their term. Now, let's say at the end of their term in 2026, rates have come down again. They can lock in for another term at 4%. By 2030, they would owe $501,000. So by 2030, 9 years after the purchase of that average price home, that borrower is still underwater. More is owed on that home than it's worth. Were the average price to drop to $500,000 due to a major increase in supply, the value of these assets held on these banks' books would drop precipitously. And we all saw what happened with Silicon Valley Bank when the value of the assets held on their books underwent a tremendous drop. And although this situation is inherently different from SVB, given that the banks are engaging in such extreme measures as offering 90-year amortizations to ensure that there isn't a fire sale of their assets, and given that the government is supporting, both rhetorically and materially, these incredibly risky moves by the banks to avoid a real estate crash, does anybody really believe that the government, that the banks, that the powers that be are going to engage in the large-scale coordination to increase Canada's supply that would in fact result with a $300,000 decrease in the value of those assets? Given that the banks and the government and the powers that be are all coordinating to provide these relief options to existing homeowners, not out of the goodness of their hearts, but rather to avoid a fire sale of real estate, to avoid a major crash in real estate prices, it's not clear that there's going to be a major effort to increase the supply that would, in fact, bring down those real estate prices anyway. And if real estate prices aren't going to be coming down anytime soon, if our financial system and our banks can't take it, which is what I suspect, then I think that's a conversation that we need to be having. As Jasmine Tour could very well be right, we could be seeing an entire generation give up on the idea of homeownership and all that that entails to a society. With that said, we will continue to track housing affordability in Canada's real estate market on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.